I think it's going to get a little bit easier for buyers come fall, especially in the single family world. And this may sound weird to some folks, but I see that as a vote for the market continuing, because that's what's needed for it to be healthy.
So the question is this: how do most agents find the secrets to succeed in today's competitive real estate market, especially when the top agents are keeping those secrets to themselves? That's the question, and this podcast will give you the answer. Hi, I'm Aaron Amuchastegui, and welcome to Real Estate Rockstars. Real Estate Rockstars, welcome back. This is Aaron Amuchastegui, and today I get to talk to Andrew Cushman. Today, it's this week's State of the Market. Andrew is with Vantage Acquisitions. Andrew and I met back in 2015. You know, he's a real estate investor. I don't really know what he would call himself. You know, fund manager. You know, puts things together, puts deals together, meets people, and I'll let him do a little bit of that. Andrew, how's it going, man?
It's going really well. Glad to be talking with you again. And I guess what I call myself, or most people would recognize, is a multifamily syndicator. So I used to be a chemical engineer. Then back in 2007, went into flipping houses here in Southern California, did the flipping thing for a few years. And then for the last, 10 years, we've been doing multifamily properties across the U.S., mostly in the Southeast U.S., done about 2,100 units. And it's been a really, really good run.
So when somebody says I'm a syndicator, what does that mean? What's a syndicator apart from multifamily?
Yeah, what that means is, think about it as like a cruise ship, right? If you want to enjoy the benefits of a cruise, you don't go out and buy a $2 billion cruise ship and then, get a couple of friends and try to go sail around the Caribbean, right? You find somebody else that can purchase and operate that cruise ship, and then you pay a fee to go to get on it and enjoy the benefits. That's kind of what syndication is. You've got like a $20 million apartment complex. Most individuals don't have the funds or expertise to take that down themselves. And so that's what our job is we go find those deals, arrange them, get them set for acquisition, and then, close on them. We operate them, maximize them, and eventually sell them. And then what the syndication part comes in is, let's say we need $4 million in equity. Then various investors will come in and say, okay, well, I want to participate with 100 grand or 200 grand or 50,000. And so the syndication is pooling investors together so that we can basically acquire an asset and share a benefit that you wouldn't be able to do individually.
Yeah, that's a great elevator pitch for syndication. It's like, no, you're not going to buy a cruise ship. You're going to get on a cruise ship.
Yeah.
Everybody else, I have not heard that before. I like it. So you're a real estate expert, man. You've been doing this since 2007 ish. You've got to see, boom years. Starting in 2007 was the market was starting to tail off in Southern California, but maybe we didn't quite feel it yet. We didn't quite feel it as much until 08, 09. And then by then it really started kind of tailing. So you've seen some up cycles, you've seen some down cycles. You're doing some really big transactions right now. And today we're going to talk a lot about predictions in the market. There's so many news articles out there right now that are predicting two different things. Some are saying you got to buy a house now or you'll never be able to. Other things are saying wait till next year. It's going to get more affordable. So much conflicting information out there. That's why I like to dig in and look at it. But two of the perspectives you're going to be able to give us today. And I apologize to my listeners if I've got like a rasp in my voice. I just had a crazy weekend. And as I'm trying to catch back up, I lost my voice a little bit, but I figured I could push through and be able to talk to Andrew today. So Andrew, you're a buyer in today's market and you're a seller in today's market. So people have been talking like crazy about it being a seller's market. Why don't you tell us a little bit about the big transaction that you just had and what that was like as a seller? What did you sell? What did you think it was going to sell for? What was the process like, and how did it end up?
Yeah, it was quite the eye-opening process. So we were selling an asset in the Atlanta area, 132 unit apartment complex. And when we did, and the reason it's a great area. The reason we're selling it is because when we bought it, we told our investors we're going to hold it for 5 years, and we're actually a little bit past that time point. So it's time to go ahead and do that. When we got together the brokers, everyone kind of said, hey, we think this thing will sell for about 17.6 million. That's kind of the target. Well, we accepted our final offer today for $20.735 million. There's so much demand in the market right now that even a lot of brokers that I talk to, they're like, yeah, we don't know how to value the properties anymore. Like even the brokers can't guess half the time what it's going to sell for in the market.
So you were going to sell it for $16 million. Now, and everybody out there, it's, you know, if it seems too giant, take it down to a $160,000 house, right?
Yeah. It scales down just the same.
Scales down the same percentage, but you think you're going to sell it for $16 million. You sell it for $20 million as an apartment asset. What was the cap rate at 16? And the person that bought it for 20, what cap rate will they get?
You know, the cap rate on that is probably in the high 3s to maybe around 4%.
Okay. What kind of an asset, like how nice of when I think of 3 cap apartment complexes, I'm thinking super, super nice trophy asset. It used to be class C, class D would get you 6, 7, 8. But if you were down in the 3 or 4s, it was like the nicest property you could ever walk through. What's it like right now? It's trading like that.
Yeah. And you know what, for anybody who's out there buying, this is one of the reasons why I would recommend going for class B or even A, because the difference in cap rates between that nasty D property and that A property, there's almost no difference in cap rates now. So so you might as well pay the same cap rate and get a nicer asset that's going to appreciate more and have less headache. So that these properties there are actually 2 properties that we're selling as one. One was built in 1999. The other one was built in 1988. They're just solid B-class properties in a rapidly growing suburb of Atlanta on the south side. And, they're not, we lightly renovated them. We did keep them in great shape. There's no deferred maintenance or anything like that. They're clean, safe properties, but by no means are they class A, new construction, shiny luxury, or anything like that.
That is crazy to me that someone would buy that big of a property at a 3 cap. When I was, first getting into multifamily, I was chasing those higher returns. So I would get the properties that weren't quite as nice, and pretty cool right now that you can get an A or a B right now for essentially the same return as the others. So if you're going to go into apartments, go big. But so that's when we're talking about the market overall, what that really tells us is there's so much cash in the market that there are people out there that are willing to get just a 3% return on their money, right? Which is lower than most interest rates right now. If someone's going to go finance an apartment, Andrew, what sort of loan could they get right now?
Depends very much on the condition of the asset and the size of the loan, because the bigger the loan, the better the terms. But, you can get bridge loans and Freddie Mac floating rate loans in the mid to high 2% range. So we just got quoted a 2.55 on a loan on Monday. If you're doing like 10-year fixed loans, kind of what a lot of people are more used to, just fixed rate, you're looking at anywhere from maybe 3.1 to 3.8. And if you're doing bridge loans or bank loans, you might be in the low 5s, something like that. So yeah, rates are pretty low. But, when you talk about it, it's amazing that people are happy with a 3% cap rate or even a 4%. The reason why is because if you look at like the 10-year bond, the real interest rates on those are negative, right? The 10-year bond's yielding like 1.38 or something like that today. And if you subtract the rate of inflation from that gives you a negative real interest rate. So getting a 3 cap or 4 cap on a real asset that will appreciate looks like a great deal compared to someone who needs to place money and they're looking at treasuries.
Wow. So as Andrew and I are talking today, I'm going to keep track of the 2 predictions as the market kind of going up or down, and based on like each little category. And when I take away from that and I say there are so many buyers in the market and they have so much cash that they're willing to take such a low return, my vote for that category would say that's telling me the market is going to continue to go up. Where would you put your vote based on that, Andrew? I
would vote the same. And this process of selling that Atlanta property has been a bit eye-opening because, there were, I don't remember, I think there were a total of 20 or 25 offers. And these were not, maybe 2 of them were kind of like, fly by night, people who don't really know what they're doing, just throwing in offers. The vast 90+% of the offers and the people who looked at it were very sophisticated, very wealthy institutions or individuals. Some of them own, 15,000 units. and they are looking at this property saying, hey, we think there's tons of upside. Yeah, we're going to buy it at a 3 3/4 cap, but we see, we can raise rents, and there's population growth and there's income growth. And the thing about the lower cap rates is the lower your cap rate, your cash flow is thinner, but your lever to create more equity is stronger. And a lot of them, these really sophisticated, high net worth people are seeing that happening going forward. So it was really kind of eye opening to us, because we're out there trying to buy too. And it was a confirmation that, hey, there's a lot of people who are much bigger and hopefully much more intelligent than us, and they're out there buying as much as they can.
Real Estate Rockstars, this is Aaron Amuchastegui for a quick commercial break. So during 2020 and 2021, the real estate market completely changed. There's so much competition in the market, so many people trying to buy and sell houses, but there's hardly any supply, hardly any product, hardly anyone willing to list their homes. It's time for every agent out there to become a hybrid agent investor, to be able to reach out directly to homeowners to try to get them to sell or list their house. We've got a new website. Go to leadpropeller.com and you can set up your own investor buyer website in just minutes. You'll set up your own URL, set up phone numbers, help go through to leads, help reach out to people that aren't listing their property currently, and have them fill out a form that says, hey, I want to sell my house. And then as an agent, you can go through and make them a hybrid offer. You can tell them, hey, I think your house would sell for $220,000 on MLS, but I can either write you a $180,000 cash offer right now, or I can help you fix it up and you'll list it for $220,000 on MLS. These are buyers that are looking for quick cash offers. Tens of thousands are submitting these forms every single day, and they're skipping the listing process. But so many of you guys out there are such good agents. It's a great opportunity to get that lead and help them maximize sales price for their home. So again, go to leadpropeller.com and think about signing up for your own investor site, so buyers will start reaching out to you, asking you to make an offer on their home. Yeah. So how about on the other side? So you're also a buyer right now. Mm-hmm. So today you got an escrow to sell a property, and you got an escrow to buy a property, or you bought one and you sold one. Either it was one of those two.
We closed on an acquisition today. Yeah.
Closed on an acquisition. So what's it like on the buyer side?
The buyer side, I mean, if you can imagine the flip side, if it's a listed property, you're going to be one of those 25 offers. And I think, anybody who's tried to buy a house or a duplex in the last 6 months has probably had that experience where, you put in an offer 50,000 over asking and you still didn't make it. So as a buyer, it's very difficult. We're finding, the only time we have a legitimate chance of getting a deal is if we make the deal. Meaning, and that could be a number of things. Meaning, so for example, the one that we closed today, it was off market, basically working directly with the seller. A broker that we know connected us. And so we got to work one-on-one. We had no other competitive bids to go against. It was just, hey, can we work out a deal that works for us? And then when we closed a much larger portfolio back in March, and it was very similar, where it was off market, there were still a bunch of people chasing the guy, throwing an offer, unsolicited offers at him. But we were able to get the deal by, meeting in person with them multiple times. And we actually arranged like a partial, like installment sale, which is a form of seller financing, which works even on $50 million transactions. Again, that's something that, you can use to create a win-win situation, whether it's a single family house or, a couple hundred apartments. And because of that structure and that off-market nature, we were able to get that deal done. But if it's a listed property, the brokers are sending it out to everybody, or it's something on an MLS or anything along those lines, we find it incredibly competitive and very hard to win those deals.
So you could still get deals if you're creative. Are there any tax incentives for a seller when they're doing kind of that seller carry type stuff? Are they pushing part of the sale back until later, or is it really just a way to get the deal done? Exactly.
You're right on track. So that was one of the things we did. We actually said, hey, can you bring your CPA into this conversation? And we basically said, look, if you structure it this way, it's the same as if we paid you another $1.2 million, because that's how much in taxes it's going to save you. right? So yeah, that was part of it. It saves the seller, or at minimum postpones a significant amount of taxes, and so that can be an incentive. Especially, one of the biggest problems today is a lot of people don't want to sell because they don't know they don't have a place to invest the money after they sell. And so if you can help solve that problem, that can help you win a deal.
Yeah, I like it. So I think that second story, I would say that's still, if I was going to vote on, do I think the market's going up or down? You've been trying really, really hard to get a deal. The only way you were able to get one is you kind of created the deal, you created the off-market deal, and you hustled. That to me says we've still got, I would still vote on the market is going to continue to go strong because there's a ton of buyers out there still trying to get properties. So would you same vote on that one too?
Yeah. I mean, there's a lot of factors, and I'm sure we'll talk about a handful of the others, but to me, the strongest one, the most reliable indicator is simply supply and demand. And right now, demand far outstrips supply, both in terms of investors wanting to buy properties and residents wanting to live in them. Yeah.
All right, I'm going to start sharing some articles, and we're going to get into some of the other ones. If you guys are watching us on YouTube, you're going to see the articles. If not, you guys will see some of them on my Instagram. I posted some of these earlier today, and a ton of you guys reached out with some extra questions, and you answered some of the polls. And I'm going to get into some of that too shortly. But now I'm going to share my screen so me and Andrew can look at some of these statistics that are out there. So this is one that, so the United States Census Bureau, this article just came out, said in the first quarter of 2021, the median asking rent for vacant rent units was $1,226. And I wanted to show you this chart. So one of the things that Andrew said at the very beginning was if someone's buying at a 3 cap, there's also a big opportunity to create equity. My understanding of that is if they're okay with a 3 cap, that the way to raise equity or create more equity is they're going to do a little bit of rent increases. And all of a sudden they're going to turn a 3 into a 3.5 or a 3 into a 4, or they're going to add an extra $1 million or $2 million in value right away just based on rents. So I'm showing you a chart here, Andrew, that shows kind of median asking rents, and then shows just a huge jump up in the first quarter of 2021, end of 2020. Have you seen this chart yet?
I haven't seen this particular chart, but we've experienced it. Absolutely. We've been getting anywhere from 5 to 12% increases on renewals in 2021. And we've got one property, the property that we closed on in March, we're spending $6,000 on the inside of the units renovating them, and we're getting 25% rent increases when we relist those renovated units. Wow. So when you're looking at this chart, it says in 2017, median asking rent was $900. In 2020, it had gone up to $1,000. So between 2017 and 2020, it's about a 10% increase, 11% increase from $900 to $1,000. And then kind of last quarter of 2020 into 2021, it went from $1,000 to $1,200. So it's gone up 20%. Rents have gone up, median asking rent's gone up 20% over the last about 12 to 18 months, compared to just 10 the prior kind of 3 years before that, which is really a wild jump up for that. Do you think rents will so we've experienced the same thing in our single family houses. Most of our single family houses are in Texas and in Arizona. And we've seen the same increase where we're getting year over year increases for between 8 and 12%. We just had a set of houses in the same neighborhood where we did rent increases. And we had actually 7 people tell us they weren't going to renew and move out, which made me question my process a little bit. Out of the 24 houses we own on that street, they're all the exact same. 7 people said they were going to move out. We listed them on the market on Friday, and we had, 9 apps this morning for all of those properties at that higher rent. So where I was worried, like, oh my gosh, are we going to have too much vacancy? No, they're filling right away with the demand, and it's about a 14% year over year increase. Do you think rents are going to continue to fly? Again, that's supply demand. Do you think rents are going to continue to go up? I do think they're going to continue to go up. I don't think the current pace of the increase is not sustainable. But every forecast I've seen is for between 5 to 7% for this year, which candidly, we're already exceeding that. Yep. And then like 4 to 6 for 2022. When you look at the demand and demand for housing and the shortage of housing, that points towards rent increases. But also when you just look at inflation in general, that we have, that typically leads to rent increases. And then we're seeing very significant wage inflation right now. Employers are having a really difficult time getting people to come back to work. And one of the ways that they're, trying to incentivize people is to increase wages. And you're hearing a lot of states and businesses say, okay, our minimum wage is now $15 an hour. And what that does, especially in the C-class properties and C-class houses, is all of a sudden those folks just got a significant wage increase. And now they can afford rent, which is great, except that increases demand because there's now more people in that pool who can afford the rent. And then that demand pushes the rent up and it ends up kind of balancing out. So unless there is some very significant negative shift in the economy, I do see rents continuing to increase. Again, I think they will, after 2021, the rate of increase will be lower, and we might even plateau and kind of flatten out for a while everything catches its breath. But how I look at it is, well, even if rents were to come down a few percent, when we're up 10, 12, 15% in 6 months to begin with, your overall trend is very steeply up and to the right.
Yeah. And if I was going to give one prediction around rent, something that you totally just hit on the head is right now, wages are increasing, especially at the service level worker, because there aren't enough people working in restaurants. There aren't enough people working in hotels. Everywhere you go, there's, we're a hiring sign. So they have to bring up that rate. They have to bring up the rate they're going to pay people. And as a direct result, rents go up. So until that kind of bottom employment market balances out and wages are stable enough where people are wanting to work again, I think we're going to continue to see rents going up at the same rate that those base level wages are. So if I was going to take the rents going up, they've gone up big, but they still have room to go. I don't think they're about to push back down. I agree with you that they're going to keep going up. That'd be another vote for me I think the market's going to continue to go up. Yeah.
And looking at this chart, this kind of jumps back to the bigger picture. A lot of people are always asking like, oh, geez, is now a time to buy? Should I wait? Should I? Well, if you look at this chart starts at 1997 and ends at 2021, right? So that's 24 years, right? When you look at this chart, there is not a single significant decline in that entire 24-year period. So what that tells me, looking at that, there's a couple of blips that seem to last about 6 months, and that's it. So what that tells us is if you buy a property that cash flows at today's rents, your worst case scenario is you might just end up holding it for a little bit longer than you planned if prices dip. But otherwise, if you've bought the right property in the right market, the last 24 years of history says you're going to be able to keep holding on to that property and eventually it'll appreciate and eventually the mortgage will pay down.
That's such a great point, Andrew, because when we look back, I remember the housing crash of 0809.
Yep,
I remember housing prices, especially in California, going from houses selling for $600,000 and $700,000 to $200,000 and $300,000. It was nutty. It was crazy. I'm traumatized by it still. And when COVID happened, I was like, I remember just seeing the flashes of, oh my God, it's like 2009 all over again. But if you look back to the biggest crisis of my lifetime, the biggest housing crisis of my lifetime on this chart, you see a small blip of rents going down kind of beginning of 2010 for the first quarter. And they went from 720 to maybe 670. And then they stayed stable until around 2011 with going up and down. And then they just went on their merry way. So when real estate prices got cut in half or 75% discounts, rent had very small discount. Super statistic there when you get to look back at. Great point. Over 24 years, also in the last year, we've seen the highest increase on this chart over the last 24 years than you see the rest of it. But we don't have a big correction down. Very, very cool stuff. We're watching history in the making right now. We'll get to see what happens. This next article is from Inman, and it says a buyer-friendly market may soon be in reach, new data suggests. This is finally something on the opposite side. The fall could bring cooling prices and more inventory, according to a new report. Buyers may catch a break from the red-hot housing market, according to Realtor.com's weekly housing trends. New listings fell 3% for the week, with year-over-year increases during 12 of the last 15 weeks. The analysis concluded that the dip was a direct result of 4th of July. The new listing growth over the past few months has helped slow price growth, giving buyers some room to breathe. And while the number of total active listings is still down 39% year over year, the decline is shrinking. In fact, according to analysts, It marked the 13th consecutive week that saw a smaller year over year decline. So what this article is saying is we still have less properties on the market than we had a year ago, but it's not as big of a gap. It's saying we're getting closer to year over year inventories. I think in some places that means we're going from a month of inventory to a month and a half, or a month of inventory to 2 months of inventory. What do you think about that, Andrew?
I think they're right, and I think this is a good thing. The statistic I heard last week was that the average days on market for a house was, I think it was 6 days, right? That's insane. I believe, and correct me if I'm wrong, because this is more, I think, in your world. I believe a healthy market is considered when you have 6 months of inventory, right, available for listing in the single family world. So, when we talk about, oh, hey, inventory is going to increase, I think that's true, because a lot of people are like, wow, I can get these incredible prices. It's a good time to, I want to take some money off the table. People are less afraid of COVID. So now they're more willing to move. They're more willing to have people come inside their house and tour it, right? So all of those things lead to a little bit of an uptick in inventory. Why I think that's a good thing is the current rate of price appreciation it's too fast to be healthy, right? We the last I heard, the median's not average, so it's a little bit different. But the median home price is up 13% in the last 12 months. We can't do that year over year and maintain a healthy, functioning housing market in society. So I do believe we'll see an increase in inventory, but there's so much demand for it that I think any significant increase will be quickly absorbed and will actually lead to a more balanced, healthy market. I don't see enough of an increase, at least in the near future, to tip us into the flip side, where it's a true buyer's market and sellers can't sell and there's no offers or anything like that. There's, one caveat would be if interest rates go very, very high, very, very quickly. But other than that, I see that leading us to a more balanced market, which is actually be a healthier place than where we are today.
Real Estate Rockstars. This is a commercial break from our podcast sponsor, Housefolios. We're in real estate to find the next big deal, right? We want to find the deal, make money, and then turn around and do it all over again. It can be frustrating having to search through thousands of properties trying to find that Goldilocks property that is just right for your investment goals. That's why we're here to tell you about Housefolios. Housefolios is a management software for single-family home investors that makes it simple to find good deals, get financing, and manage your property portfolios all from one platform. They're an all-in-one app that lets you easily search for properties, both listed and unlisted, analyze numbers based on your specific assumptions, and provide resources to get you through underwriting and closing. And this is a feature we like most. You can track your numbers at multiple levels. Want to see the returns on the specific property in seconds? Check. How about an entire portfolio of properties you're looking to buy? Check. And then being able to present these properties to investors to become the go-to real estate agent for their investment needs? How awesome is that? Managing your investment properties has never been easier. The best part, it's affordable. Plans start at just $29 a month, $29 to unlock the tools to manage your entire investing cycle, all in one place. Check it out at housefolios.com. And if that's not enough, Housefolios is giving our listeners a special rate on an entire year of Housefolios, just $99. So instead of $29 a month, $99 for the year. Head on over to housefolios.com/RE Rockstars to sign up. Again, head over to housefolios.com/RE Rockstars to get an entire year of Housefolios for only $99. Yeah, we used to decide if 3 to 6 months is healthy. And once the market got into 3 months of inventory, we felt like that was a great neighborhood to go try to flip it.
Mm-hmm, yeah.
Great. If we can sell a house in less than 90 days, and that's a nice, safe investment. So yes, I think there's, listings are going up. I think people are getting a little bit discouraged. And so buyers are taking a little bit longer to try to, it's taking so long to get the houses. I think some buyers are maybe coming off the sidelines, but the demand is still so much higher. So if you were looking at that, so that article pretty much said, hey, we see average listings going up, months of inventory going up a little bit. So they think the fall is going to be an easier time to buy houses. Do you agree with that? And then also, do you think that tells us the housing market's going to continue to go up? Do you think it's going to go down, or do you think it's a neutral sort of comment?
I do agree with it. I think it's going to get a little bit easier for buyers come fall, especially in the single family world. And, this may sound weird to some folks, but I see that as a vote for the market continuing, because that's what's needed for it to be healthy. If we continue at 13% growth year for a long period of time, that's going to lead to something completely unsustainable.
That is such an interesting point there. Andrew's point of if the market, continues to go crazy for another 6 months to a year, we're more likely to see a crash or a correction that's big. If we kind of slowly get into a healthy market of 3 months 3 months of inventory, 6 months of inventory, we don't see that price correction and that price correction. I'm a little surprised by your vote on that one, but I think I actually, as you talk through that, I agree with it. I agree with the concept that it would be better if we get to healthy instead of seeing crazy 20% year over year, 20% year over year, because that is the correction.
Yeah. So I think my official vote would be neutral, because because if it goes too far, then yes, we could have a bit of a decline. But when I look at it, I'm gonna say it would have to go a long ways to get into the too far category. So I think in the immediate term, I think it's a healthy thing. So I would vote positive. But the reason I say neutral is because, well, if it were to continue and get to 9 months of inventory, then that changes things. But I have a tough time seeing that happen in the near future anyways.
Yeah. So I did one of the polls I did today. I did a few polls before coming on here based on some of the articles that we had shared. And I said, is buyer demand as high as it was 6 months ago? 1,000 people voted on the poll. And 47% of people said, yep, multiple offer craziness. And 53% said, nope, it's slowing down. And so that's a pretty even. That's some people saying, and I think that probably depends a lot on where you are in the country. So there's definitely places where people are saying there's more houses on the market. They don't see lines out the door anymore. It's starting to average out. I got a lot of messages like that in their area. It's still a strong market, but they're not having to compete against people anymore. I have some houses for sale right now that we don't have multiple offers on. Yeah, I've got some houses that put on the market and we're getting a lot of showings, but it's not selling for way more than asking like they were a few months ago. So I think that it is slowing down slightly. I still think that the right properties priced properly sell like crazy. So Andrew, one of the other polls I did said, do you think interest rates will be higher or lower a year from now? What would you vote on that?
I guess it depends on which interest rates you're talking about. So if we're talking about Fed funds rate or SOFR or something like that, I could see them still being right where they are today. 10-year treasury and, mortgage rates in the single family world, they could, there's definitely a case for them being higher, but they also could, again, be right where they are today. And that may sound crazy, but a couple of things I'd point out. Number one, inflation and interest rates are not the same thing. We can have crazy inflation and not have higher interest rates, right? So if you look at today, like we have, lumber's way up, copper's way up, steel's way up. We have shortages of everything. Gas is up. Prices on just about everything we consume are, at least in the short term, through the roof. But interest rates are still at dead bottom, right? So we currently have pretty high inflation, but we still have super low interest rates. So they're not always the same thing. And actually, probably the Goldilocks scenario for real estate is I shouldn't say high, not crazy high, but inflation with low interest rates, right? Because of that real estate is basically a bundle of commodities, right? All those things that we just talked about go into building real estate. You've got wood, you've got copper, you've got, steel, all these things go into a house. And then wage inflation, we talked about earlier, the price of that, the value of that real estate goes up, but you still have really low interest rates. That's about as good as a situation as you get for real estate. And the reason I say that I'm not fully convinced that interest rates will necessarily shoot up is, yes, the United States is doing pretty well with COVID and pretty well opening back up and getting things going. Much of the rest of the world is not. And there still are significant deflationary pressures out there that will kind of balance us out. The other thing too is if think back, to 3 or 6 months ago, if you listen to or talk to anybody, everybody was absolutely convinced that interest rates in terms of the U.S. Treasury were just going straight to the moon. Right? Like, better catch it while you can. Interest rates are going up. We're going to be at 2%, 3%, 4% on the U.S. Treasury. Well, in March, that 10-year Treasury topped out at 1.79. And since then, it has steadily declined. right? All the way to, I think today is 1.38%. So what that says is the U.S. bond market is basically the largest financial market on the planet, right? And so one of the most sophisticated, largest financial markets and instruments on the planet is saying, yeah, we know there's $5 trillion in stimulus. We know everyone's printing money, and we still don't see interest rates going up in the near term, right? So, and then often, I used to trade in the markets as well. And there's a rule that is anytime there's a consensus, that consensus is usually wrong, right? So we all, myself included, were pretty convinced 3 to 6 months ago, interest rates are going up. They have to, and they've gone down. So I'm not, would I sit here and say interest rates aren't going up? Heck no. Because traditional economics would put me in, say I'd be a nutcase. But the bond market is saying that the bond market doesn't believe it. And so, it's that, to me, that's a really tough call to make, because there are some significant conflicting signals on that one.
This is such a fascinating, fun talk for me as you and I get to go through this, because some of the questions that I'm sending to you, so much stuff about, out of the 1,004 people answered this one, rates higher or lower a year from now. And I need to be more specific too, because they did not say what rates do you mean, but the 86% of people said they believe interest rates are going to be higher a year from now. So on maybe my only poll item, we have a consensus, and that's probably the scariest one, that you say, don't believe that right away. So I think that's some really, really great info. That's fun.
Well, if you don't mind, I got one other just anecdotal piece of evidence. Some of the most sophisticated apartment buyers I know, like guys in the 10 to 20,000 unit range, they are doing almost exclusively floating rate loans right now.
That's wild. And I guess that's also why someone would buy at a 3 cap if they think their interest rate's actually going to go down. If their interest covering it, they think rents are going to go up, their interest rate has a chance of going down. That is, man, again, I'm still traumatized by the crash. And so anytime I get debt, I want to get debt that I can lock in for a while instead. But you're saying, no, we don't have to do that right now. We might be surprised, especially those. I like to tell myself Blackstone is still buying right now aggressively. I keep buying aggressively because they
keep in mind that inflation destroys the value of debt and makes the person who got that loan richer. Yeah.
So everyone's saying, let's get more debt. Next article says boomers are only making the 2021 housing crisis worse. This is from Business Insider. They said boomers have more real estate wealth than any other generation. Unlike previous generations, many of them aren't listing their houses for sale as they get older. It's exacerbating a historic housing shortage, which makes it difficult for millennials to buy homes. So that article to me, it says they're not breaking the traditions, or they're breaking the tradition of selling. They've surpassed the silent generation per the Times data. Well, this peaked in 2011. 49% boomers still hold 44% of real estate wealth in 2021 compared to 31% of Gen Xers. So it's a sign that boomers are aging in place. So have you experienced that much out there? Do you think that has as big of an impact on the real estate market as they're saying there?
I think it has some impact. I'm not sure quite how significant it is. I think to me, it would seem like the most direct impact is it's withholding some inventory from the market. And therefore that contributes to the shortage of inventory, and therefore, contributes to the very competitive buying environment.
Yeah. And one of the things they also compare in that article, millennials, so 10 years ago, it was really hard for millennials to, buy real estate because of, student debt and things like that. And so then during the recession, and now the housing boom is making it really hard for millennials to buy real estate, and trade off that the people are staying in their houses instead of selling. So it's, less supply on the market, high demand, and it's kind of comparing the two demographics that way, which makes it interesting. All right. So would you say that's a market continues to go up, market is neutral, or market goes down on that news?
I mean, if that continues, that's a positive for the market in terms of pricing, because go back to the economics 101, supply and demand, that limits supply, which means that demand by limiting supply, you have a fixed amount of demand, that the smaller supply, prices and rents will probably continue up.
Yeah.
Real Estate Rockstars, this is a commercial break from our biggest podcast sponsor we have right now, Rent Ready. It can be fun getting a new real estate deal, but it can be tough managing your properties after the fact, especially if you're long distance investing or trying to manage multiple properties by yourself. That's why we're here to tell you about Rent Ready. Rent Ready is a property management software that not only makes it easier to manage all your real estate deals from one platform, but they also have the best customer service support in the biz. They're an all-in-one app that lets you easily manage properties, collect rent, list units, screen tenants, sign leases, all from your phone or computer. Imagine all of your real estate doors right in your pocket. How awesome is that? The best part is it's so affordable, one flat price for everything. Unlimited properties, tenants, and support with a real live human. And I have to add in there, that's a new business model that not a lot of people are doing. There's like this freemium model where people say, hey, you can try this, but as soon as you grow, it's going to cost you a lot of money. Or they kind of punish you when you get too many emails on your list or too many comments. They aren't going to punish you when you grow. They're not going to charge you more when you get 10, 20, 30 rentals. They're going to charge you the same when you have 2 or 3 as they will when you have 50 or 60. So you have a nice fixed cost, all software, all in one place. Check it out, Rent Ready, RENTREDI.com. And if that's not enough, Rent Ready is giving our listeners a special code you can use to get a whole year of Rent Ready for just $54. Use code ROCKSTAR50, that's Rockstar50, and sign up for Rent Ready's annual plan at rentready.com. Again, RENTREDI.com with code Rockstar50 to get Rent Ready for only $54.
Here is one of the interesting pieces of news. So one of the articles that I shared last week said new home construction is down, and that's bad news for the housing market. And part of the decline in construction starts was that construction had gone up so much. Big reason was rising material costs. Lumber, for example, had been short supply. Single family construction dropped more than 13% in April compared to March. I talked to people a month ago about how, inflation in commodities like this could be temporary, that technology would be able to bring it back down. And this article just came out July 13th. This one came out today.
Nice.
Lumber prices, this was markets from Business Insider. Lumber prices have turned negative now for the year after a red hot rally as the home improvement boom cools. Lumber prices have turned negative for the year as demand has cooled after a red hot rally. The futures price fell 5.6% on Monday, taking it 0.6% below where it started the year. Now it's still up from 12 months ago, but it's down from January 1st. Home improvement demand has dropped while suppliers have raised production. They're starting to get back into motion. That's kind of that technology coming back into play. Lumber soared in the first few months of 2021 as they're stuck at home. Prices peaked at $1,730 per thousand board feet. I guess, what's it at now? So it's saying now they're down to 712. So it's down. It's at $712 per thousand, and it was at $1,700 per thousand. So it's down 60% from where it was in May. That tells me that builders that have been waiting can start building again. I'm in escrow on a bunch of new construction houses, and I know the builders were stressed out about material costs as we were locking in these new constructions, and I'm sure they see that and they're like, let's buy all the lumber we can right now. That statistic is fascinating to me that came out today. I was surprised to see it because even that they could get it that quickly adjusted, because they were talking about they needed more people working in mills and production to be able to get the lumber back out there. Now they have somehow done that. They've caught up with it. That tells me that can lead to a healthier market, and or that will increase supply. So that's probably the only statistic for me so far that says supply will increase. And so that's the one thing that could lead to prices going down, at least on the new construction side, if material costs are now down 60% of where they were from May. What do you think about that?
Yeah, I mean, that will eventually, that's a little bit of a longer lead time thing, right? You talk about new construction, your delivery is what, at least on multifamily, it's like 18 to 24 months out. But yes, that would lead to more supply, which would help things cool down a bit. Getting back to kind of what we talked about earlier, I think that's actually big picture. That's a good thing, because the current increases, would lead to, if they continued, would lead to a very unhealthy market. So in one sense, yes, it's a vote for down because it'll cool things down. But in big picture, I think that's healthy. And then also, I don't generally track lumber too closely, but I believe the long-term average for lumber is about 412. So 716 or 762, whatever that was, is still pretty high. All right, it's still a 70 or 80% increase over normal, which is going to lead to, higher costs of building.
Listeners, he said, I barely keep track of this, but I think the normal number is around 412. So you're barely paying attention to what's going on here, but you're absolutely, but he pulls a number out that I think is absolutely accurate. So yes, before, February 2020, March 2020, lumber is going to be around 400 per 1,000 board feet. So we're still up from then. We're starting to see that correction. Maybe more builders get out there. Andrew, you're a wealth of information as we get to go through this stuff. I knew we were going to have so much fun today.
Oh, I love these conversations. I could do this all day long.
The other side of this, listeners, is Andrew had no idea which articles we were going to be talking about today. We're in a mastermind together. We talk periodically. He sends out these apartment letters to people about doing different investments, and I was just glad he could get on today so we could talk about this. I've got a few more articles as we're wrapping up just our last probably 10 minutes of the podcast. This next article says, wait until 2022 to buy a house, economists say. So here's a news article that is saying it's going to get easier to buy a house next year. Let's see what they say why. They say prospective home buyers will face low supply and high prices for at least another year. The U.S. doesn't have enough homes to meet demand, and builders are struggling to keep up. But economists do see price growth cooling in 2022, but only if construction picks up and demand holds steady. So they're saying, again, supply demand. If supply goes up because construction goes up, but demand doesn't go up at the same price, then it says America is still in a seller's market when it comes to housing and could stay there for at least another year. Prices are climbing at the fastest pace in more than 3 decades. In May, the average listing was only on the market for 17 days for it to become a buyer's market for sale. Unless construction picks up, the near-term outlook for prices is promising. So millennials are hitting peak home buying age is one of the things that it says in there. So as long as demand kind of stays solid. It also said builders didn't know 2020 and 2021 were going to be some of the best years in the housing market ever. They would have needed to plan for growth year. So 2019, they would have had to build out and get it takes them a couple years. And I'm remembering this, builders got burned after the late 2000 bubble burst as homes away from city centers hurt their books. And so they've slowed down. Now we see a lot of building going on. But overall, that article says it's going to cool off. Now, in one sense, that doesn't tell me prices are going to cool off. That tells me that the supply and demand gets back to a healthier market. So around that 3 months of inventory. If you combine that with, interest rates, maybe staying the same or going down, then you've got houses being more affordable a year from now. And maybe their headline is a little bit not super forthcoming. It says, wait until 2022 to buy a house. Most people are saying, should I buy a house now or should I wait? Should I sell my house for top dollar and buy again in a year? And what's going to happen as they're trying to forecast. So this economist is saying, wait until 2022. What do you think about the things that they're saying in there?
Well, first of all, market timers almost always lose. That is almost never successful. There's a few people got it back in 2006 and 2007 because there were some very, very clear signals, but generally speaking, market timers tend to lose. I think the thing to get out of that article is they did not say they're expecting price declines. They said they're expecting growth to slow down, right? So that doesn't say prices come down. That says the rate of increase slows down. So if you're looking at a $250,000 house that's appreciating at 10% this year, maybe next year it only appreciates at 3%, but it's still appreciating. So if you're waiting to get in, just hoping to get a lower price, that's not what the article is saying. And candidly, I don't think that's going to happen necessarily. At least not in most markets. Also, the other thing to keep in mind is most home buyers aren't truly shopping on price. They're shopping on payment, right? So the true thing to look at is not just the payment of the house, not just the price of the house, but it's what does that mortgage payment look like? So when you take the price of the house combined with where interest rates are, that's the really determining factor of how much cooling and growth that we might see. For example, if you look at the last couple of years, prices have shot through the roof, but rates have come down. So therefore, that payment is still affordable. in most cases. I mean, clearly there's market extremes and examples of where it's not affordable, but just generally speaking, even though prices have gone up, as rates have come down, those dropping rates have made that payment affordable, and the vast majority of Americans are shopping based on payment. So I don't think that article is saying that a crash is coming. I think they're saying a cooling of the rate of growth, which again, I hope that happens. I think that leads to longer term market health and sustainability.
So if you were going to vote, prices keep going up, prices keep going down, prices neutral, sound like almost like a neutral type vote on that. That article doesn't shift your thinking one way or another.
No, I'd say neutral. In fact, I think the article is correct. I mean, I do think we're going to see a cooling in growth. But again, I think that's a good thing. Because what they did not say we see a decline in prices in 2022. They just said, hey, we see a slowdown in growth. So if you're looking to buy a house, and you're saying, well, I want to wait till 2022 to things cool down a bit. If interest rates go up, let's say prices actually do come down a bit, right? Well, if interest rates have gone up, your payment's either going to be the same or more, right? So, if you're a home buyer looking to live in it, what you want to do is secure the lowest payment. If you're an investor looking to get a rental property, you want to secure the lowest payment because you want to have your rent exceed that payment because, regardless, the only time the price of a property matters if it's a rental is when you buy it, refinance it, or sell it, right? So if you buy today and it rents well and you get cash flow off of it and the price declines 20% over the next few years, and then you just keep renting that thing out, right? Go back to that early chart where during the Great Recession, rents basically stayed flat, right? So let's say that happens again. You just keep renting that sucker for a few more years, and then as long as you can cash flow it, that with inflation and everything else, eventually that pricing comes back up, and it ends up being a great long-term investment. So that's how I look at that, and how I would advise people to evaluate it.
I remember Robert Kiyosaki saying, he never lost money on real estate, and on some of that he would say, well, I haven't sold it yet. I remember a couple bad deals in 2012 and 2013, and we kept them as rentals instead of selling them. Instead of selling them and taking $100,000 loss at the time, we kept them as rentals. And now we're able to sell them for what we had in them, and instead of taking that giant loss and doing it over time. So that was a lesson that we got to learn too. You talked a little bit about timing the market too. And I was talking to a good friend of mine today, and he called me and he said, hey, I want some advice. I'm selling a property in one state. I own a property out in Florida. We'd really like, he's got a giant property up in the northern US. Now he's got a property down in Florida, but they essentially want to sell their big one to buy a bigger one down in Florida, but he's trying to figure out how to time the market. And he's saying, hey, should I sell my $4 million house up here? And should I sell my $3 million, and that's this high-end luxury, and my $3 million luxury house in Florida right now, and then wait until next year to buy my big one in Florida, my big one on the ocean, my giant one, because I think prices are going to come down a little bit or not. And so that market timing type thing, the advice I gave him was, I said, the selling the northern, US property right now, I think right now is a great time to sell it. There's political things that would be pushing that in. There's reason to believe that maybe the person willing to buy that right now, and so it's in the state of Michigan, not great economics going on there right now, not great political stuff right now. And so it was thinking through that the ideal buyer for that luxury property up there's maybe going to be fewer of them a year from now. So I thought that was a good idea to sell. The other advice I gave him was not to sell his Florida one until he was willing to buy his next Florida one. So the advantage of selling it, if you sell at the top of the market and you buy at the bottom of the market, now that's brilliant, right? That's forecasting. Yeah. I had Sean O'Toole on the podcast, a couple months ago, and he timed some markets just crazy. He sold everything in 2005, built foreclosure radar in 2007, and then we had the housing market crash. Like, brilliant guy, predicted a lot of different things. But unless you're going to predict exactly, the benefit of selling at the top of the market, the downside is if you go buy a house right now, you're going to be paying top dollar. But if you sell a house right now, you're going to be selling it for top dollar. So I told him, if you're staying in the same city, the same area, the same sort of thing, don't try to time the market. Sell the property when you're ready to buy, because you're still going to get the benefit. It's going to offset the extreme prices you're paying now, or the extreme prices you're paying 6 months from now, are going to be offset by the property you're selling is still that same price. I don't know if I communicated that properly. Would you have give properly to you? Would you give similar advice?
Yeah, I think so. I mean, if you're moving markets, that can make a lot of sense. If you're trying to buy and sell in the same market, I don't think that makes sense in terms of, trying to make gains on pricing. The one time that could make sense is when it comes down to the velocity of money, right? When you look at the return on, if you've got a ton of equity in a property and you look at not how much you invested in it, but how much equity you have in it, and then the cash flow you're making, your return on that equity could be super low, right? So if you sell, take all that equity and leverage that into either a bigger property or multiple properties, you're increasing the return on that equity. So that's a good reason to sell and stay in the same market. I would say it's, if you're just like, oh, this market's high, I'm going to sell and then buy another property a year later in the market. I think in most markets, that's probably, the odds are against you. But if you're trying to say, hey, I want to sell out of this market, which maybe you've got some concerns about, and then get into another market, then yeah, right now could be a great time to do that. And I would say any market that you have any concerns about going forward, maybe a market that you think has economic headwinds, or if we get into a recession is really going to suffer. Yeah, like it's kind of sellers markets that we're in now. This is the right time to cull the herd, right? Where basically, if you've got any weak properties or properties that have been a headache, or maybe are difficult to manage, or in a normal market might be tough to sell, now is the time to unload those and use this as an opportunity to take, unload weaker assets and redeploy that capital into stronger assets and stronger markets.
Yeah, we're totally doing that with our single family stuff right now. Anything that doesn't have that strong cap rate. The weird houses sell right now. The ones with the funky plans, the funky something, they sell right now. And there are so many good markets that feel strong and they've got all the good news. So I love kind of that your tie on at the end there that says, no, if you've got a place that you're questioning the future of that place at all, then it's a great time to sell now, because right now is strong. And there's plenty of markets out there where you can put your money, where you're not questioning the future because it feels like stuff is strong. So Andrew, do you have a few more minutes? I have just a couple articles left. I know we had a hard stop right now. Or do you have another thing you're jumping onto?
Yeah, sure. Go for it.
All right. So I'm going to jump in and we'll do our fire round on just our last couple. I was just going to share with people. I posted, an article last week that said your rents are going to keep going up. We talked about that one. The Great American Land Rush is wiping out the starter home. And it's saying, starter homes were at the historic lows. And Feds know skyrocketing home prices are a problem, but doesn't know what to do about it. So all those articles are saying market is going to be going strong. And I'll just run through these last ones, and then we'll go through just one or two little questions that people sent in. The other article I mentioned earlier, pension funds are pumping money into single family homes rented out at a profit. There's so much room to run. And so I like to go where Blackstone is going. I like to go where the people that are spending the money on the research, I like to believe in that too. Pension funds are pumping money into single family homes rented out at a profit. There's so much room to run. They believe prices are going to continue to go up, probably for things like what Andrew talked about, rates staying stable or rates going down at the same, while we also see rents going up. Even if rates stay the same or go up slightly, rates are not going to go up at the same rate as rental increases right now. If rents are going up 10 to 12% a year, I don't think we're going to see, rents, interest rates doing the same thing. They talk in here about, including investors, single family rental buyers purchased a record $77 billion worth of homes the last quarter of 2020. So that's kind of the last good news one. And I'm going to jump into the other one that is now finally talking about some foreclosures in here. This Foreclosure Watch, the 10 most at-risk U.S. cities. As you start going through the statistics of possible foreclosures, I had a few people ask questions about foreclosures. It says Atlanta, Georgia, 17% of the loans in Sandy Springs are delinquent. 12 are seriously delinquent. And in that area, 17% are backed by FHA. Houston, Texas, total of delinquent homes, 17.4%. Chicago, Illinois, 18.8%. This is an article from Inman that came out. Dallas, Texas, 19.1% delinquent loans. We'll track a ton of data on that I'll probably be talking about on my next State of the Market podcast. So we've got these areas. Riverside, California, you know about that area over there. San Antonio, Texas, Fort Worth, Texas. A lot of Texas has a lot of delinquent loans. Now, historically, what people should put into perspective is California and Texas have the most foreclosures. They always have. There's been more foreclosures in those places than others. So it's not super surprising to see those stats on there. But have you been following? Some of the questions is, if something's in foreclosure, why wouldn't someone just sell it? And even at that level, they're not going to see the supply come up enough to really make a big impact. What do you think about the Wall Street comparison of them buying houses, but also the other side of that maybe there's some foreclosure risk now?
Yeah. And, I started when I was flipping, that was in foreclosures. That's where I started. And it's amazing that, people in foreclosure, there's a certain percentage of them. They for whatever reason, they don't want to face reality. They just, pick your reasons. They just hold out until the last second and don't sell and whether it's false hope or, whatever, they hold out until it's too late and they lose it to foreclosure. I do think we will see some increases in foreclosure. At the same time, I don't think the current administration is going to let there be a huge wave of foreclosures. The CFPB, Consumer Consumer Finance Protection Bureau, has already been given warnings to lenders. They have very sternly come out and said, with kind of some dark undertones, like, you better make sure there are no preventable foreclosures, right? And, so I think what we're going to see a lot of kicking the can down the road, extending forbearances. And then also a lot of lenders learned their lesson last time. They don't want to have thousands of REOs. So I think what we're going to see when the moratoriums and the extensions stop, I think we're going to see a lot of loan modifications. So people who want to stay in their homes can get their loans modified. They claim COVID, and if it's a government-sponsored loan, which is the majority of them, they're probably going to be able to get a modification. And then, like you said, anyone who is even remotely proactive and can't get a modification or can't stay in the home, they can sell it. There's very few homes right now that are still underwater and can't sell. So I do think it'll lead to some inventory. Again, I don't see a 2008, 2009 style flood of foreclosures.
Yeah. We've got the data in Dallas and San Antonio, and from the foreclosure postings that happened in last July, none of them actually went to sale as the beginning of the moratorium. Only 25 to 30% of them have actually sold, have actually sold to third party or had anything happen, which means 70% of them are still kind of in that kind of defaultish area. But I do agree. I think in September, they're going to unlock foreclosures, but I think that individual banks are not going to release them at a skyrocketing level. I think we'll probably see the numbers go back to, we were seeing 6,000 a month in Texas before March. Now we're seeing 1,500. There's 60,000 as a backlog. Maybe they'll get back up to 6,000 or up to 6,000 or 8,000. So I do think they're going to come out. I think a lot of times people will sell them. There will still be those that people don't. In general, it's going to make it a healthier market as well. So one of the last couple of things that people put on here, they said, some of the people said, the Fed's really going to allow foreclosures? Somebody said there's too much conflicting news right now, and so time in the market is better than trying to time the market, as Warren Buffett says, so he's still buying. Another guy says real estate is saturated at a fever pitch. It's 2007 all over, junk bonds and all. TikTok, I told him to go vote. Overall, so there are some people that say it's going down. A lot of our articles said it's going up. There is, for listeners, you want to hear more about foreclosures? I'm going to talk more about foreclosures next week. The last thing I asked, with so much conflicting news, I said, will prices be higher or lower a year from now? 61% of people that talked to me said they were going to be higher a year from now. When we looked at our voting, Andrew and I we had 6 or 7 votes for markets going up. We had 3 that were kind of neutral. Maybe we had 1 or 2 that said the market's going down. Overall, I think a year from now, prices are going to be higher than they are right now. And then Michael, and then Andrew, thanks for all the extra time. What's your final vote on prices a year from now? And then how can people reach out to you?
My final vote, to be fully transparent, it makes me nervous because after 10 years of growth, everything in my brain says, well, it's got to go down. But when we just took a pretty, objective walk through quite a few factors. And when we objectively looked at each one of those factors, the majority of them were up, a couple of them were neutral. So I have to vote for, I think prices are going to be at least somewhat higher next year. And that's how we're operating, is on that assumption. We're doing everything we can to hedge against in case that's not correct, but we do think that is going to be the case. For both single family and multifamily, that prices will be higher next year. As far as connecting with me, probably the best way is just our website. If you Google Vantage Point Acquisitions, that'll be the top search result. The website is vpacq.com. There's a handful of tabs on there that you can connect with me. Just where it comes to my inbox, we can set up a call. We also have a mastermind for people who are actively investing in real estate and want to be part of a group of other people who are doing that to share resources and expertise and learning. That's probably the best way is Vantage Point Acquisitions. So.
That's awesome. Yeah, Andrew and I, we met at GoBundance. If you guys want to come hang out with us, there's a GoBundance event next month. Maybe you guys can come see us out there.
I'll be there.
Yeah, I'll be there too. We'll be able to chat, do some more of these conversations. Andrew, always awesome to talk to you. Thanks for coming on Real Estate Rockstars. I hope you guys like this. Thanks for listening.
All right, Real Estate Rockstars. This is Aaron Amuchastegui jumping in again to thank you for listening to the show. Hopefully you guys loved listening to that one. And I want to make sure that you know about all of the extra resources that we have. And also, we need your help. They say podcasts are free. You get to listen to podcasts for free. But what is the cost of that podcast? I would say if I could beg you to pay anything for that podcast, I would say the cost of the podcast is going and giving a review. So whether you download it on Google or Apple or YouTube or anywhere else, please go give us a review. Say what you liked, what you didn't like. It helps us get better guests. The more reviews, the higher we get in the rankings. Right now, we are the biggest podcast out there for real estate agents, and we want to keep that spot because we know there's lots of podcasts out there. So go give us a review. Also, be sure to go to hibandigital.com. If you liked any of the resources that those real estate agents talked about, we've got a huge video vault of those resources for free. Every penny that comes on the podcast that we interview, they give us something that helps them get their deals or helps them work with their clients. And we put that in the toolbox in our vault for you. So go to hibandigital.com and you can get it. If you're looking for real estate education, go to rebusuniversity.com. We have all sorts of courses in there to help agents succeed in real estate. How to get the listing, how to negotiate deals, how to become an investor, all sorts of different stuff, rebusuniversity.com. And if you want to chat with me, go find me on Instagram. And if you come find me on Instagram, you can send me messages. Tell me what you want to hear. Tell me what you liked, what you didn't like. We try to put a bunch of content out there too. You can find me in two different places. It's at rerockstars.com for our Real Estate Rockstars page, or at aaronamuchastegui.com for my personal Instagram page, where I can chat with you about all sorts of different things. Thanks for listening. We'll see you again soon.